Hi, welcome to my channel. Today I want to share with you my updated valuation of Salesforce. They just reported on the 1st of March, fourth quarter and fiscal year 2022 results, and I want to update my financial model, my projections and my fair value based on that information. I have already uploaded a video of Salesforce on the July 2021. I'm going to leave a link up here because I discuss all the qualitative attributes of the business in that video, including the management and financial position and competitive advantages. All that analysis is valid today, and in this video I'm only going to concentrate on the projections and trying to come with a new fair value for the company with all this information. So let's go to it. First of all, let me show you the highlights from the fourth quarter release. Revenue was up 26% on a year-over-year basis. The fiscal year revenue was 25%. Current remaining performance obligations of 22 billion, up 22%. Fiscal year operating margin of 2.1% and non-GAAP operating margin 18.7%. I really don't pay attention to that because the difference between these two is mainly stock compensation, and I think that it needs to be included in the results. This number is a little bit lower than the competitors, and we'll discuss that in a minute. The operating cash flow was really good, 25% growth year over year. They are also raising the first quarter revenue guidance and the operating margin guidance for the fiscal year to 3.6%. Much better than this one, but still this number is quite low in my view. Then they had some highlights on the call that they didn't mention in the release, and which are interesting to show. The fourth quarter of 2022 attrition between 7 and 7.5% at an all-time low and below the 8% of the third quarter. The number of deals over 1 million up 34% year over year, and those deals over 10 million more than double. This is quite good. The fourth quarter 2022 number of deals over 100,000 for Slack, up 42%, and Slack is really growing fast. It's going to be 1.5 billion approximately in sales for 2023, for fiscal year 2023. That's what they are expecting. Then they mentioned that the operating cash flow and free cash flow was even higher than what they mentioned before if we remove mergers and acquisitions impact. So before it was up 25%, and without the mergers and acquisition impact was 27%. And the free cash flow also very strong growth. If we see this, the disaggregation of revenue by product category, we see that in Sales Cloud, 15% year-over-year growth for the fiscal year. On the Service Cloud, 20%. Platform and others, 36%. Marketing and Commerce, 25%. And then Data, 28%. So all these numbers are really high levels of growth. And if you see this one, 15%, which is the first service with which the company started 23 years ago, is still growing very fast. So after 23 years, they're going to turn 23 years in March 8. Mark Benioff mentioned in the call. So it's amazing that they are still growing at this level. Going to guidance, they guided for full year 32 to 32.1 billion in revenue. The growth 21%. GAAP operating margin, I mentioned already, 3.6%. Operating cash flow, they are guiding between 21 and 22%. And then on the call, they mentioned that the capital expenditures to revenue, they are going to have approximately at 2%, which is much lower than in the past few years. And therefore, the free cash flow growth is going to be between 25 and 26%. So all this is what I'm going to update my model with. One interesting point to mention, if you see here, revenue and remaining performance obligations. Here we have the total quarterly revenue and operating margin even though I'm going to focus only on the revenue here. And the remaining performance obligation is all the revenue, all the future revenue under contract that has not yet been recognized as revenue. And you see here that the growth in the last 2 years, from this quarter to this quarter, has been 51%. And in the remaining performance obligations, 42%. So you may think that there is a deceleration of the company in terms of the revenue, but I don't think that this is anything of concern, because if you note here, this remaining performance obligations has been accelerating in the last few quarters. So I'm not worried about that. Let me show you my income statement. From here we have the historical 10 years and my projections here down here. I'm going to show you here the projections I had before and back in July, to give you an idea of what I'm changing. In this column here we see the actuals for January 2022, and down here we see what I was expecting, and you see that I was expecting revenue a bit lower than what they came up with, and EBITDA of 3.3, and they came with 3.8. So, and if you see for January 2023, my expectation was 30 billion, and they have guided 32 billion for January 2023, and they have guided 3.6 as I mentioned, and I was assuming 4.1. So the EBITDA is going to be a bit smaller than what I was expecting, but then I'm making an adjustment on the operating margin, because before I was assuming a very small growth in operating margin improvement, let's say, and based on the information that management has provided, that they say that the non-GAAP operating margin they expect to be at least 30% around the end of the decade. So I have changed this operating margin, as you can see, much higher than what I was expecting before, 5% and now 18%. And of course, EBITDA is going to be much larger. But then I'm adjusting also the ratios I'm using, so we'll see that in a minute. So that's the main changes I'm making to the income statement. And in the cash flow, this is again historical and my projections. And again, I'm going to show you what I was expecting before in my projections. And you see here the actuals, 6 billion in operating cash flow, and it's what I was expecting. And the free cash flow of 4.8, and they came with a bit higher because the capital expenditures were below what I was assuming. And if you see here, I was expecting January 31, 26 billion in free cash flow, and in my projections now for January 31, 26.9, so very similar. So there isn't much change here in the cash flow statement. Then let's go to the fair value with those numbers. So EBITDA 29 billion as I showed you, and free cash flow 30 billion for 2032. I'm using these ratios now, which are lower than what I was using before. So with these ratios, and I get the enterprise value, market capitalization, and divided by the stocks outstanding, I get the price. So my target price is 761. I use this average in this cash flow, assuming that I buy the stock today or yesterday, that it was at roughly $210. I have this free cash flow adjusted, and this price, which is the one I just calculated here, and that gives me this table. If I buy at today's price, the IRR of this cash flow is 17%. And if I go all the way to 355, meaning 70% over what's the price today, I would get the 10%, approximately 10% that I normally look for. And so this is the new fair value, 355. That means that the price to fair value is 0.59. So it's quite a large margin of safety, almost 40% of margin of safety. Let me show you quickly what I was using before in July, and the price was 315. and now it's 355. But you can see that before the price was 242 and now it's 209. So not only the fair value has increased given all the information we got from the company, but the price has decreased. So we have a much larger margin of safety. And one thing to note here is what I was mentioning about the ratios. The ratios, I am using much lower ratios than before. I think that these ratios were a little bit on the high side, and I have now reconsidered, and I'm using, these are ratios similar to the competition, like Adobe and even Microsoft, those type of companies that are growing fast and are in the same type of industry. So, and let me show you one thing here, the sensitivity on projections. And what I mean by that is that if you have such a large margin of safety, 40% in this case, you can either buy the stock at 355 and get your IRR, desired IRR, or you can see it from the perspective of the safety on your, the margin of safety that you have on your projections. So if we multiply all these numbers by 0.59, these two numbers, it will give me the average, which is going to be 0.59 of the actual average. And if I put that number into my cash flow, and I also multiply these numbers, these free cash flow numbers that I get by 0.59, this will give me exactly 10.36 as the IRR. So in other words, I can get to 10.36% either by paying a higher price, which would be the fair value, or by reducing the projections by 40%. So that means that I have room for this company not to deliver what I am projecting. Almost it can go to half of what I'm projecting, and still I will make, if I buy it at 209, I will still make roughly 10% of return, which I think it's a good risk-reward proposition. That's my updated valuation of Salesforce. It's a company that all the qualitative attributes of the company that I mentioned on my previous video are still intact and valid. I still like this company. It's growing really, really fast, and it's growing even faster than what we were expecting 5-6 months ago. I don't know if it's going to keep growing that fast in the next 10 years as the projections that I'm making show, but as I said, the growth can even go to 60% of what I'm assuming, and I will still make, if you buy it at $210, you still make roughly 10%. So then this is the nice thing about investing with a margin of safety, that you can be 50% right only, and you still make a good investment. So, well, that's all. I hope that you find this video interesting. Please don't forget to subscribe, and also click the bell to get notifications. And if you like the video, if you find it interesting, please give it a like. And that's all. Thanks very much for watching. Bye bye.